What is up, YouTube, and welcome back to another Fridge Financials video. In today's video, we are updating you currently on where the markets are. The economy, the inflationary pressures, the labor market, everything you need to know right now, we're going to be talking about in this video here. So if you are excited for today's video or just curious to know my perspectives of things, make sure you like the video, subscribe to the channel, and as always, turn on the bell notifications, as always, for all future uploads. We are in a wild time in this market and in the U.S. economy as a whole. And you might be looking there and saying, Fridge, why? The markets are rallying, they're doing great things here. What is there to worry about? And let me tell you, there's some craziness that is going on here. And it just puts us in a perspective of who knows what is going to happen here. So, believe it or not, recent information has come out about the Federal Reserve and, about one of the Fed chairs, which is Christopher Waller. So Christopher Waller, who is a Fed member, suggested, he came out earlier last week, or maybe it was later, a couple days ago, at least last week, suggesting that we should have a rate cut December 10th. And it should be on the table still and everything else. Now, rewinding it back a little bit here to what's going on, taking a look at the markets here, okay? So what you'll see here is a side-by-side of S&P 500 and the volatility market index here, okay? So this tells you about how volatile markets are, and this is the S&P 500 basically being tracked from SPY ETF. So what you will notice here is that we've had some crazy volatility over the last little over a week or so in the markets overall, okay? And the question is, well, let's start off with why, okay? So this day right here, this insane candle that you see right here, this one right here, which is like the most, I think it's probably one of the most insane ones I've seen in a long time, is the day where SPY was up 1.5% after NVIDIA earnings, then proceeded to close down 1.5% on the day. That was a wild swing. It was up 1.5%, and we closed down 1.5% in one day. And the reason why, and again, you can see this big volatility candle here on the same day, November 20th here. There's that big candle here. So this is Thursday, Friday, and then Monday, Tuesday, Wednesday, then Friday again. So you can kind of get the map of the candles here. And then you see this nice rally from the market after this. We have this crazy, insane candle we had here, big volatility spike here, and we get this big soft happening afterwards and what the reason is behind it. Well, this candle happened on the 20th because we started to get data again. As you know, the government has been shut down for, over 30 days, and now it's opened back up. And data takes time for it to come in. We haven't gotten labor market data. We haven't gotten inflation data because no one's been working for the Fed at that point. Well, not everybody, but a lot of people have not been working for the Fed. So no one's been able to gather these kind of data points here, right? So taking a look back at what's going on here, okay? So Christopher Wallace comes in and says, I think we should have a rate cut in December 10th. That's when the next FOMC meeting comes out, and now we're trying to figure out what's going to happen on December 10th, a day before my birthday, fun fact. So, now this comes on the behalf of, we had recently, about a week before that, or a couple days before that, where we had two Fed come out saying they want a rate cut in December here. Now, why are they coming out and saying that? Well, taking a look. So this is kind of where the Fed is at. The Fed is in this wild position right now. And the idea behind the Fed is what's called dual mandate. They want to have high employment and low inflation. High employment, low inflation, right? So data comes out recently, and it's not bad data. It's actually relatively good data in terms of the labor market in comparison to what we would have expected here. So here's your non-farm payrolls, and I did this over the last couple of years here. As you can see, we've been on quite a little bit of a decline in terms of non-farm payrolls. Now, non-farm payrolls, the idea behind it, again, is looking at people that are being employed and stuff like that. And as we'll see, we are on a big downtrend here as a result of it. We're on this downtrend of less people that are employed. Now, what you'll see is you have this big spike here from this data point that did come out. We had this big spike here recently, which was a big beat in terms of expectations. And the Fed have been cutting rates recently, not because of inflation, but because the labor market has been rolling over. And you can see that right here from the end of last year to now where we're at the end of this year. We've had this big decline in the labor market, right? And this big decline in the labor market is troublesome because, again, they want to maximize employment, and we're not having that right now. But we had this big data point of now, hey, we had a better than expected jobs report in the month of September. We were looking for like 57,000 and we got 119,000. And people are like, oh my God, we don't need to cut rates because the labor market's turning around. Now, that's where these candles come into play here, because this data came out the same day NVIDIA earnings. Market rallied because of NVIDIA earnings. Then this data point comes out and says, hey, our labor market is better than expected here. We don't need rate cuts. Rate cuts are off the table here. The market is turning around for labor. So we are in a very, very good spot. We don't need to cut rates. Now, the market tries to price in this idea of rate cuts and the idea behind it. And what you'll see here is that the rate cut percentage of us getting a rate cut right here, which is at the 350 to 375 basis point here, was a month ago was only 66% right now. Now it jumped to 80 to 71 a week ago. Now it's up to 86%. It's starting to move up. And what happened before, if you were tracking this data here, if you were watching the interest rates that they were looking at in terms of what they want rates to be at for the economy here, is that once this data point came out, when this came out right here, the probability of a rate cut crashed to like 30% because people were like, we got to unprice this now. Now we have to unprice this rate cut because the markets have been rallying and we've been saying, hey, this has been great. We love the rates. We love that we're getting rate cuts. We're going to get this nice little rally here going on here. Then this data point comes out and people are like, wait, hang on a second. Now we have to unprice in this rate cut because the labor market is doing better than we thought. So we had that happen on Thursday. So we had a big market sell-off on Thursday as a result of it. But then what happens on Friday, before we get a bad data point again, markets rally again on Friday. And why is that the case? Well, because two Fed came out and said they are on the same side of us still having a rate cut still. Okay? Because we're still waiting on, the jobs data is, iffy, it's behind, so two Fed members came out and said, hey, we're kind of in favor of rate cut. So the market was like, well, we just unpriced in a rate cut, and now we got to price it back in again. So we had a huge rally on that Friday right after that. Right after this close right here, we actually had a big rally here towards the end of the day where we actually closed up, I think it was like 1% or maybe a little over 1% on Friday. Then we had this big rally coming in because Chris Waller comes down and says, hey, I still think we should get a rate cut in December. And the probability skyrocketed of us getting a rate cut here. And that's where the volatility comes into play here. As markets go up, the volatility goes down. So this big spike that we had in volatility was more because of the fact that we were trying to unprice in this rate cut for December. And so now we're kind of in this territory of, okay, well, Fridge, what's going to happen now? So two members come out and say, we support rate cuts. Chris Waller comes out and says, I still think we should have a rate cut on the table in December 10th here. So that's three members talk about rate cuts potentially here as a result of it. The market is pricing in a rate cut again. So you had this big dip because they unpriced it. Then they got this, big rally because we had to reprice it in after these Fed members came out and said these things. And now we're at an 86% chance of a rate cut on December 10th. And the reason why markets rally around rate cuts is because it makes it cheaper to borrow money. It makes it cheaper to borrow money, which means that it's more money going into markets, going into companies, going into businesses, and it's going to hopefully boost up the economy as a result of it. Okay? That's kind of what the idea is behind it. The idea of them doing rate cuts here is because since labor market is starting to show, again, labor market right here is showing that we are in a declining period of labor. In order to stimulate that, if we make borrowing money cheaper, then those businesses, those big companies, corporations can start to hire again and borrow at cheaper rates to then use that money to then hire more people to grow their companies. And it hopefully will help to stimulate the labor market here. Okay. Now, the Fed's in a big problem though right now, because as you will see, the labor market has been on a decline here. Okay. And taking a look here, this is our unemployment. Look at our unemployment. Our unemployment over the last, 2.5 years, almost 3 years now, has been on an uptrend. It was at 3.5% back in January. Now it is up at 4.4%, which also came out that same Thursday. So unemployment slowly starting to increase. Unemployment's going up. Labor market is starting to show that turnover period here. And then what makes it even crazier, if you take a look at our CPI data, which talks about inflationary pressures and about what pricing is going on here, we had this big crash here, and then all of a sudden, look at this big spike we've gotten as a result of our CPI over the last, 8 months. Actually, this is more of like 6 months because they didn't have data right now at the moment in time here. But so the Fed is in a tough situation. And the reason we're being is because rate cuts are good to stimulate the economy. Rate cuts are like when the market and the economy is starting to kind of, really start to collapse under pressure and feel these kind of pressures coming from whatever's going on. Rate cuts are there to help stimulate the economy. It doesn't say, oh, it's bullish for the stocks. It's bullish for stocks. And it's like, yeah, of course it is. But the difference that we're facing now is that inflation is the CPI, our CPI data here, is higher than what we want. The Fed wants 2%. CPI is around 3% right now, year over year. Okay. Now, what are rate cuts going to do to our CPI data and to our PCE, which is our personal consumption expenditure, and to everything else? Well, rate cuts make borrowing money cheaper, which means people have more access to it, which that means people are then going to be able to spend more of it and put more money into the economy again, which is like, oh, it sounds really good. But that makes the value of the dollar less, which means that items are going to become more expensive because it's a lot. We're going to be printing more money, essentially. We're going to have more money, being pushed into the economy here, which means the dollar that you had today is going to be worth less after this happens, right? When if all these rate cuts keep coming in, your dollar you have today is going to be worth maybe 95 cents or whatever the case may be in, a year or two, because we're going to have more money pushed into the economy because we keep printing it, right? So what this rate cut will do, and what the fear is of the rate cuts, is saying, do we cut rates to stabilize the labor market? Do we cut rates so we can kind of get this big rebound recovery period here? Because right now we're not really looking too hot right now in terms of labor market over the last, couple of years. Our unemployment is also going up, which we do not like to see either as a result of this. So labor market is really bad right now in terms of it's starting to really feel the pressures of AI and stuff like that. Do we cut rates to try to stimulate the employment with the risk of us also pushing CPI higher? And again, think about back to 2020 during COVID, right? During the COVID times, interest rates were at 0. Then we started to see big inflationary pressure come in afterwards. And then so what does the Fed do? They start jacking up interest rates to combat inflation. That's what usually happens. So with inflation on the uptrend, people are saying we shouldn't be cutting rates. We should be trying to raise rates essentially to make this kind of happen. And so that's the problem that the Fed is facing right now is, do we cut rates for the labor market, or do we leave rates where they are to try to stabilize inflation? And that's the problem that we face as, the Fed faces as dual mandate, because now you're in a tough situation. How can you fix employment and also contain inflation? And that's a huge problem that we're facing. Now, we're pricing in a rate cut right now for December 10th of 86%. At one point, it was 90, then went down to like 30-something%. Now it's back up to 86%. So we get a lot of this volatility as you're seeing in the markets overall, because we're trying to price it in, then unprice it, then price it in. All that kind of stuff's going on here. This is where it gets tricky. The Bureau of Labor Statistics, which is where I pull all these numbers from here, which releases all the information about CPI, about inflation, about everything you need to know about here, cancels October inflation report due to the shutdown. They are now behind. So the BLS is so behind that we can't even take a look at October's inflation data. Okay. What we have right now, this is September's. This is for September's, not October. We don't even have October yet. We're going to be in December, and we're not going to be seeing October's until mid-December, which is a problem. So the BLS announced Friday, this was a little while ago, that it would not produce its monthly inflation report in October because of the government shutdown. And that was the big fear. Everybody started to think when we had the shutdown, people were like, oh my God, it's so amazing. Markets are going to be loving it. And markets did love it for a little while because no data was good data for us. But now we're trying to fill in, like, okay, now we're trying to like predict what the data would have shown because now we don't have anything. So now we're in this kind of no man's land right now as a result of it. So we initially had this nice big rally here because no data was good data for the Fed and for the stock market because we couldn't see how bad unemployment was. We couldn't see how high inflation was. We couldn't see those data points because of the shutdown. So the market's like, yeah, let's keep pushing higher, baby. Boom, pushing to all-time highs. Here we go. Then we started to face this uncertainty period because now it's like, well, what's the data telling me? Are we doing good? Is it rebounding? We don't really quite know. We started to get this volatility here as a result of it. Big problem. Now here's the big problem. The BLS will not release the update on the CPI for October because it was unable to retroactively obtain information that would have been collected during the record long lapse in funding. Great. From October 1st to the November 12th, which was that, government shutdown, which is great. Now, this is the problem. The cancellation of data means the Fed will not have any new major employment or inflation data to consider before its final rate policy on the 9th and the 10th. And the other thing that I almost skipped over is that they already canceled the jobs report for October. So the Fed that's going to be meeting on December 9th and 10th to talk about interest rates and where we're going to be going on December 10th here. Now they're relying on data that has been slowly somewhat released and CPI and labor market data that came out in September. They don't even get the October ones. That's a problem. Because now, usually, the Fed will be like, all right, well, let's take a look at what we had for the last month's data here. Let's look at unemployment. Let's take a look at non-farm payrolls. Let's look at the labor market overall. Let's look at the JOLTS report. Let's look at CPI and PCI, and PCE and PPI. Let's look at the last month. But now we don't have that. Now we do not have that. And it's not going to come out until after this decision is made for the Fed. And this article talks more about who it is and da-da-da. But this right here is a guess at this point in time for me. Me personally, this is a prediction priced in rate cut here that this market has. Because I don't know what the Fed is going to do with this rate cut. This is the first time for me, I feel it is uncertain. Even though this is a high probability of a rate cut coming in December 10th in about 2 weeks, this to me still feels uncertain because there's not a lot of data points to go off of this to make this decision. And if they cut rates, they got to be ready to see how CPI reacts, and the labor market's going to react. And think about it this way. They cut rates on the 10th, and this data comes out afterwards, and CPI is already higher than what it was in September for October. It's even higher than before because of tariffs and whoever knows what else. This rate cut's going to make it worse, right? And that's a problem. Now, let's say they cut rates, and the labor market actually has already shown a pivoting point, and we didn't need to do that. Now the rate cut is going to put more money in the economy, try to stimulate the labor market still, and inflation is going to be already being pushed higher. This is a huge decision that the Fed has to make here. Huge decision. And honestly, with this rate cut here, I wouldn't be shocked if the more important thing is seeing what CPI and jobs market and labor market data shows after this rate cut, December 10th. Okay. Now, going off of this right here, this is very, very important. On December 10th, investors will have to contend with a double helping of event risk. The November Consumer Price Index report is going to be released that morning. And I don't know how true that's going to be because that's CPI. I don't know how true that's going to be. And they're going to be deciding about rate cuts or not. As you will see here, they're pricing in a 1.3% swing in this market, which is the highest of biggest implied move for the rest of 2025. And, this non-farm payrolls here. Like, I don't like, again, this is like a question, isn't like, do we get this or not? Who really quite knows? Like, what we're gonna get for data afterwards here, right? But your FOMC is gonna be your big catalyst for the rest of the year. And we're used to having the Santa Claus rallies. We're used to having it because it's euphoria, it's the holiday, people are traveling, they're spending money, they're buying, they're going to retail stores and the spending is happening and the businesses are doing great and the hiring is gonna be good because we need seasonal workers and all these different things here. So people love it. And now who knows what's going to happen? This market is going to move in a wild direction on the 10th. We are either going to get a huge rally with a rate cut, which would be exciting, or we are either going to get a big pullback if we don't get a rate cut. This rate cut right here, even though it looks like, oh, fridge, it's definitely going to happen, or it's a really good chance of it happening, I really don't believe that because the data is so behind that we're looking at right now. So, am I worried? Yes. Should I be hedged? Yes. And I will be hedged for my portfolio in case we get this big kind of pullback as a result of it, because you never know what's going to happen. Again, this candle right here, this guy right, I can get rid of this one right here really quick. It's fine. It's fine. Oh, there we go. This candle right here is my worry. And if you take a look back, where's the 20th? This. Let's go. Let's make it just look like this is what happened as a result of it. Look at this. Big rally after NVIDIA earnings. Biggest pullback I've seen in this market in a long time. From here, let me give you a nice little data point here for perspective. From the high to when it closed was a 3.5% swing in the S&P 500 on the day. And that was around here. And the volatility is about 1%. You're looking at even a higher implied volatility now. So I don't know what's going to be happening. I would be hedging your portfolios, but this is crazy because this is uncharted territories. This is not the Santa Claus rally that you're probably used to, because the Fed have a big, big decision to make. And the decision that they're going to make on December 10th is going to be huge. And everybody and their grandparents and their friends and family will be tuning in to see what Jerome Powell says here. If he's dovish, great. If he's hawkish and he comes down and starts cracking down on things, be prepared for a roller coaster. And the day after that's my birthday, so we can all celebrate together, hopefully, when the market does great things, hopefully. So thank you guys so much for watching today's video. A lot to unpack here, and there's still plenty of time to figure out what's going to be happening here. But if you did make this far in the video, make sure you like the video, subscribe to the channel, turn on the notifications as per usual for all future uploads. Hope you make it in the market in some way, shape, or form. Hope you're ready to see what goes on here. And as always, I will catch you guys in the next video.